right, good morning and welcome to our panel on alternative capital executing against the narrative. My name is Scott Watson-Brown, a partner with PwC Bermuda, and I'll be your moderator this morning. While you have the panel topic in front of you, our panelists will tackle this in three parts. We're going to look at innovation and operating models, where we consider new and innovative risk transfer solutions, together with demand for emerging and changing risks. We're going to consider investors. We're going to look into the current markets with the opportunities and lessons learned that are arising in the present state. Then we're going to open it up. We'll have a polling question, we'll give you the opportunity for some interaction, and we'll allow some questions from the floor. As we go through it, through your app, you're able to pose questions to us as well, and we'll look to see if we can pull those up and respond to them as we progress. To introduce our panelists, starting off just next to me to my left, I have Dan Brookman, Senior VP with the alternative capital business at XL Catlin. Next to him is Guy Swayne from Nephila Capital. And then finally on the end, Tony Rettino from Elementum Advisors. So to start off just with innovation and operating models, I guess maybe Dan, just to start us off. I mean, there's been numerous mention in the press of late about the reinsurance industry and its need to stay relevant and keep moving forward. Maybe you can give us some insight as to what you think the industry needs to be doing to drive this forward.
Sure. I think that you can look at this question from a number of perspectives. Firstly, within reinsurance, we're in the risk business. So it's, as we've heard on the previous panel, it's about making risk relevant to different types of audiences, different types of risk takers, whether they're traditional or investor-based. And as Mike said, it's important as an industry to keep capital or risk capital interested in yourselves. And so when we think about maintaining relevance and intertwining that with innovation, I think it's important to try to target what is it about the risk itself and the process of transferring that risk to third parties that works and which parts could be made slightly better. And so when we look at innovation, that in this space, it's precisely looking at how you can identify risk, parcel it up, move it on to the appropriate balance sheets. And it's really that ability to quantify risk and look at it from different perspectives, which drives innovation. So big believer that when you bring people from different backgrounds, different markets into a new market context, and draw on their experiences of how they've solved things in the past in different scenarios, you generate new opportunities and new transactions, and that keeps the change going and relevant for the industry.
Guy, I mean, your perspective is it'd be interesting from you and Tony, I mean, not affiliated with a traditional reinsurer and out there on your own, just how you view innovation and how you see it moving forward and even how you deal with it in your own firms.
Sure. Well, I think the first comment would be that innovation has happened. The previous panel talked about how the market conditions were post-2005. I'm old enough to have been in Bermuda, around 92 after Andrew. And the period after those events, it took a long time to bring capital to the dislocation of the market. When capital was needed, really the only route was a secondary offering, or if you're in Lloyd's, hopefully you got dispensation to overwrite your stamp and take advantage of the market and bring capital to bear. What you see now is, and you've seen it in the last 3 or 4 weeks, when there is a slight dislocation in the market, when there's apparent opportunity, capital can come extremely quickly. Much quicker route via sidecars, funds, cat bonds. I mean, cat bonds aren't quick, but that's another source of bringing new capital to the market. And that's been a big change. Getting that capital is much cheaper than it used to be, much more efficient. I think that is an innovation that's already occurred. And I think the key for the industry, whether it's insurance, reinsurance, traditional, or ILS or a fund, is how do we continue to grow the pie of insurance? One of the things that came out of Harvey, for example, quite staggering how much homeowners insurance didn't buy flood, no coverage for losses. And that's in the United States. You look around the world, there's an awful lot of risk that is not bought, is not distributed, and even now remains heavily reliant on governments around the world to step in and help those affected individuals. And that wasn't so long ago. I mean, in the States, you know, the wind pools, the CEA in California, much of that risk resided on government balance sheets. And it's only in the recent, I forget now, 7, 8 years that a lot of that insurable risk has been transferred to the reinsurance market. And a much more effective use of capital pre-event versus post-event with the government having to step in.
Tony, you.
Yeah, I think, I mean, fundamentally, we're matching capital and risk in the most efficient manner. And that's a lot of what the changes that we've witnessed over the last 25 years have been about finding a more efficient, delivery mechanism to match that capital to the risk, in the quickest and most efficient way possible. So, Guy mentioned, Harvey and what's happened in Houston. I mean, we all have probably read by now that, there was studies out as early as 1998. Tropical Storm Allison, I remember that, flooded Houston very dramatically. Nature finds a way. We just because we plow over marshlands and put up houses and sell cheap flood insurance doesn't mean that water's not going to collect where water's meant to collect. We need a public-private partnership to get better flood mapping. A flood is an enormous opportunity globally. It is no pun intended, it's a disaster in the U.S. The delivery mechanism is not efficient. And, it's a clear area this year where we have to say, we have to learn from what's happened. We have to find a better way to solve this. And, it starts with better risk measurement tools, which, by the way, this industry is pretty good at developing. Finding ways to bring capital to bear, which, by the way, this industry is pretty good at doing. So I think those are the types of things we need to be focusing on.
Are there any barriers that are going to slow down this progress? Or, we say that innovation has happened, but I mean, the industry needs to continue to evolve. Are there any barriers out there that are slowing progress down, or anything holding certain parts of the industry back? I don't know, Dan, if you...
Sure. I mean, certainly there's, for innovation and progress, it requires an identification of what the current status is, what needs to change to improve. And that's going to require time and effort for research, for example. Or as Tony mentioned, if it's looking at, underinsurance or disaster gap, it's on how do you measure a risk that's not being covered and recognize that a lot of risk capital in the world requires measurement and models of some form or data to be able to transact in this risk. And so it requires incumbents in the industry to commit to wanting to push the agenda, to commit resource to isolate exactly what needs to improve and change, and fund some of the research into that, and be there as an advisor for clients, as a capital provider or a partner for third parties to put the wheels in motion to move that risk or change that reality in the industry.
What I mean, alternative capital is quite often touted as an opportunity to lead the way in innovation, etc. But I mean, is that a correct statement? Should it be out there front and center, or is it more working side by side with traditional reinsurers who have, I'll say, the capacity to deal with research and development that goes on?
Yeah.
Guy, thoughts?
Well, I think the previous panel said, which was pleasant to hear actually, that there's a place for traditional and alternative. We both exist side by side. Alternative is here to stay, which we've been around 20 years now, and it's the first time I've really heard it being accepted now. So I feel like we've actually arrived, which is nice of Mike to say that. I think one element of innovation is, our industry doesn't distribute risk very efficiently and very effectively. There's a lot of archaic ways of transferring risk around the world. So I think, there's a lot of talk about insurtech and lots of ways of making it easier for individuals to buy insurance through an app or whatever, and then, I mean, cut out a lot of very, very old-fashioned ways of moving risk and moving money. It still staggered me yesterday where I physically had to sign a piece of paper in ink and post it back to a certain country in Europe. They just didn't accept electronic signatures. Right. I mean, that is prehistoric, really, as far as I'm concerned, and that is extremely expensive. So I think the area that, the traditional model is much older than the alternative capital, so inherently they have much older systems and much more expensive process. The alternative capital is being newer, I think much leaner, much more nimble. So I think, side by side, I think we can collectively as an industry try and drive technology to really improve how risk is distributed throughout the whole system.
Yeah, I think the barriers are usually data and transparency. I mean, basically, committing the research to understand the risk better so that it can be transferred, and then transparency. I think one of the interesting things that's going to happen here is that one of the lessons, and I think the lines alternative traditional just continue to blur. Every event, we should be learning. They're different models, and they're meant to accomplish different objectives, so they can coexist. But I think you're going to find, for example, that a lot of on the reinsurance side, there's going to be continually a push for transparency. The idea of saying we're going to tell you what happened once a quarter, and we're going to have these reserves, and we're not going to really disclose a lot about what's going on in our book, we think that is going to change and needs to change over time. People need to understand the cost of equity capital for a rated balance sheet with the level of transparency is higher because people just don't know, what are the reserves. And it used to be that we'd create new codes every time because we had no idea what the reserves looked like, so let's just create a new company, right? That's not efficient, right? So I think the line will move that way. I think we're going to find people in the fund business, particularly people that are kind of newer to the fund business, are going to learn about, the value of good old-fashioned underwriting, things that, really need to be done, which I think we've lost over the last, several years. And I think people who haven't faced a loss will now face a loss, and losses bring clarity, and it's an opportunity to learn. So I think there's, on both sides, we're going to have a lot of lessons.
I mean, you touched on briefly the protection gap and the troublesome area around flood with Harvey. I mean, other than an event in itself drawing attention to a protection gap, again, what sort of advancement is the industry making as far as looking around the world to developing countries, et cetera, for other opportunities that are out there to perhaps diversify risk they can write? Dan, again.
Sure. So I mean, many years ago, on Wall Street, we spent quite a lot of time working with governments and also charitable organizations about how to deliver risk transfer solutions for humanitarian purposes in emerging markets or sort of underdeveloped markets. And what comes from that work product is it's very difficult to apply traditional either insurance, reinsurance, or even ILS technology to that problem, because in some of these areas there's just no insured value or extremely low insured value. And so what that leaves you with is still the reality of natural hazard, natural catastrophe in zones like Pakistan for earthquake and so forth, but without the typical metrics that the insurance industry has used of insured values to make a market, to identify a market and price it. And so you're left with the need to rely mostly on parametric-based solutions. So it comes again back to data and measurement. So being able to populate these places with measuring instruments that will start to give you data over a time period that people can then start to assess risk. And so that's one way that you can look at opening up emerging markets or underdeveloped markets for insurance product for risk transfer, and that's similar to how a traditional rated balance sheet will welcome any new line of business that offers margin and diversification. Similarly, investors think the same way, and sometimes in the capital markets, people will say the only free lunch is diversification. I think it's still somewhat early stage within the ILS investment community to venture too far into these brand new territories. But it is something that investors ask about and that traditional insurers and reinsurers are trying to forge a path forward on.
Okay. I don't know if there's anything you want to add in on that?
Maybe a couple of things. I mean, the one area that I guess the ILS space has been able to assist is in the cat bond space or in the bond space, where there have been bonds from the Philippines recently that is there to transfer risk post-event. I just flew back from Asia at the weekend, so apologies for the cough. But I met with somebody who is doing an initiative in India on micro-insurance. And there's a colleague of mine in the room from a previous company. I think we were trying to do that 10 years ago. And it felt like in 10 years, very little progress had been made. The numbers are very small. You need the government to really push those sort of initiatives. And around the world, that takes a lot of time, a lot of patience, and that's tough to execute.
Yeah, I think part of it is on diversification. I think that's it's an interesting question because there's been a lot of talk about, ILS funds should be diversifying, and I kind of look at that as, again, when you look at the cost of capital for a collateralized model relative to a rated balance sheet, the cost of capital advantage is in the peak perils, not in the non-peak perils. So it doesn't necessarily make sense for if I'm a large pension plan and I'm putting 1% of my assets in, and the 15 to 27 best price risk, that gives me almost no diversification benefit to my balance sheet. So when we think about putting together risk portfolios, we think about it from the balance sheet of our investors, right? That we're creating, not necessarily the balance sheet of what people like Dan's company and other people are thinking about, and that's all very rational behavior. So I think it's just, again, as long as you can match the capital and what the capital desires and the needs are, with the right risk, then that's going to create efficiency.
Tony, you mentioned interesting segue into investors there and marrying up that risk with their needs and what they're looking for. And obviously, investors are a key component of each of your business models. Maybe in the current market, given the recent events, etc., over the last 6 months, how are investors reacting? How are they feeling?
Yeah, I think the very interesting thing is how measured people are. I think it's always interesting to read the articles that there's a flood of capital on the sidelines, right? Everybody's plowing back in, right? These people spend many hours and over many years to try and figure out what their investment strategy should be within the reinsurance space, right? This doesn't move like a monolithic class of people here, right? So I think just what has been really interesting for us, at least, is that we found, and our capital is basically all institutional capital, so I can't speak to some other forms, but we found that there's been a very logical response. It's not, well, if I can't get 15% more, then I'm not coming back in. Well, 15% more of a bad risk is still a bad risk, probably, right? It's not about what the price increase is, right? It's about what has been your experience, right? Did your manager provide you with transparency? Yeah. We spent a lot of time. We talk to some people anywhere from 2 to 15 times a year. We try and get thought pieces out so they understand what LAE is and what's AOB and why should I care about how they buy insurance in Japan or Australia or whatever it happens to be. Everybody should be doing that type of stuff, and I think this is going to be one of the measuring sticks. Is going to be how well did the capital feel that they were informed and how transparent were the people that were managing that capital, whether it's a sidecar or a fund or whatever. And so I think the experience is going to be way more divergent than kind of the press has kind of characterized it. But I think that what you're going to see is that people will be looking at this isn't as part of a portfolio. I think the thing that will be proven will be that this capital is sustainable. I thought it was proven before, but I still got questions about is the capital, are they in for the long term? Well, I think this is going to hopefully once and for all end that question, and we'll just say, okay, they are in for the long term. Now let's just move on from that, right? Yeah. Anyway, I think it's going to be interesting to see how the different parts of the market react to that.
Guy, your experience?
Yeah, I think, I'd concur with everything that Tony just said, maybe add a couple of points. Investors are investors. Doesn't matter whether it's in the ILS or in traditional reinsurance or in any other sector they invest in. The one thing nobody likes as an investor is surprise. So I think whether it's Tony's company, my company, Brian's company, or any company, the results over the last 6 months of losses, are they in line with expectations? Is that what you said the range of loss would be? Or have you surprised us? And if you surprise us in a bad way, which is normally what happens, they're just going to make a decision is, okay, Guy, you surprised us, you don't know what you're doing, you haven't got a handle on it, we're going to up and move down the road and move into Tony. It's not that they're going to get worried about the sector. They understand it. They're very smart investors. Spend a lot of time doing due diligence. And that's the only thing I think you'll see is over time, and the previous panel said it's going to take a period of time for these recent losses to really become established and understood. And there'll probably be some questions and answers, not necessarily for 1/1, but some point during 2018. And those questions will be asked.
Dan, in your firm?
Yeah, I think I'm always a little bit cautious around the wall of capital concept coming into the space post event, because I've just sort of seen after 9/11, 2005, even 2011, different capital respond differently to the situation, and going back to 2011, was with probably one of the world's largest pension funds about 8 weeks before the Japan earthquake. And they said, we've been doing, spending our time doing the research. We're ready to come in with a sort of a modest allocation to ILS and reinsurance, in the small hundreds of millions. But that said, if there was a dislocation event, let us know, as soon as you see that. And we have a whole different war chest of capital which could mobilize $1 billion or more to respond to that. And then so eight weeks later, the Japan earthquake happened. We called them up and said, we're seeing a dislocation, probably a short burst opportunity in retro. And they thought about it for a little bit and came back with comments like, can't trust the models, ring of fire, we're out of here, we're not coming in. And I think that's a sort of a nice anecdote to show that nothing's a given, that when confronted with a market situation and confronted with industry participants saying, I'm seeing a dislocation, and we can look at the data and the time series, that capital, even opportunistic capital, doesn't always just guaranteed show up. Right. And so I think that what we're seeing in recent times is more established allocators to the space that, as we've been hearing, that the more that they can become aware of what's in their portfolios, what can happen, so minimize surprises, makes them comfortable with their longer-term stable allocation to the space, and they'll adjust up and down the quantum of that allocation as markets change. But you do still see some, even now, some investors who have been thinking about it for some time. They've been waiting for that change. But talking to one yesterday, they said, you just don't know that now next year's going to be 5 hurricanes in a row. And so we're really unsure. And so it's never, I don't think it's a given, and the market has to work with that.
Okay. Well, I guess if we think, I'm hearing a lot of listening, understanding what your client or investor base is looking for, and we're hearing how they're, I'll say, standing up to the current returns, etc., that are being put in front of them. Opportunities, though, that are coming out of the current markets and lessons learned. Are you looking at, again, new ways to package up risk for investors? Are they looking to push the limits on what they're currently exposed to? Guy, maybe I'll start with you about some of those questions for investors and just how they're reacting in the current market.
Yeah, I think again, first and foremost, the one time our industry really does learn is when there's been losses. And, we've had, as Kevin O'Donnell previously said, we've had 5 events, all very different, some of which the models responded well, like Irma. Some events, the models did a bad job, Harvey with flood, etc. So, the one thing, whether you're in the RLS or the traditional, is understand the mistakes you made, and I'm sure we all made mistakes, I know we did, and figure it out and try and improve the way you analyze risk. And the more knowledge you have of that risk, the easier it is to package it and present a product to your investor base. So I think that's nothing startling about that. I think every person in this industry should be doing the same thing. And as we said before, there's a lot of, it's been 10 years since we've had these sort of events, so there's a lot of people in the industry on both sides, broker and underwriting, that are having to learn some tough lessons and get up to speed pretty quickly about, losses do happen, and did we underestimate them or overestimate them, and how do we change our view going forward? So I think first and foremost, that's number one. And then, there's lots. I totally agree that in theory there is a lot of capital sitting out there, but it's not necessarily just rushing in. But we've seen whether it's pension funds, some of the retail money, it's getting educated quicker. It's finding different ways to enter the industry. The barriers are breaking down. So if we don't continue to innovate and provide a service to some of that capital, it's going to come in a different way. So, sitting still and just doing the same old approach and product that we did 4 years ago probably isn't sustainable.
Tony,
Yeah, I guess I would say that one of the nice opportunities we have with these events is differentiation. So I think one of the issues we have with the cycle is that, sometime around, I think, 2013 or so, differentiation kind of started to leak its way out of the market, right? So the rising tide lifts all ships, rates are going down, doesn't matter. And I think that, this hopefully is going to be a reminder. There are some people who have businesses that are operating extremely well and are operating within expectations, and their losses are within expectations. And there are some that are going to underperform. And the price of risk should be different for A versus B. And I think when we get into a softer market environment, we lose that. So one of my great hopes is that we keep differentiation. Like, differentiation stays. I love a differentiated market. It's a great opportunity to put together well-constructed portfolios to support people who are really building quality businesses. And so we think that is one hope I have and one great opportunity that we hope that differentiation stays. The other thing is maybe if this market can prove that the days of 50 and 100% price increases are over, and that there's a cap on pricing, maybe we can put a floor on pricing, right? Let's just think about that, right? Let's just think about maybe we live in a little narrower band here where we don't let the terms and conditions slip, and we don't let the margins slip, and we find an appropriate level of terms and conditions and pricing that we can all live with, that are fair to trade with going forward. And we can spend our time doing all sorts of things, not worrying about, I just took a loss, so I have to take 24 hours away from the hours clause. Only to then 2 years later, someone says, I need that 24 hours back. Like, we spend so much time trading that stuff back and forth. Like, we should be able to figure out what's the right way to trade going forward.
Dan, thoughts on the current?
I think the differentiation point is crucial in that, in the asset allocator space of pensions or sovereigns looking to choose managers to manage their money in this space, they really sort of fall into two camps. There's either the allocator that says, I'm going to choose one manager and that's it, and I'll be done with them for this asset class. And there's others who prefer a multi-manager model. And so for the latter camp, the ability, whether it's posting differentiated returns or in loss scenarios posting differentiated losses is quite important for those end investors. So they can start to see through recent events were they picking up, Caribbean losses from one manager because they had, a footprint there versus another manager that didn't have the Caribbean losses but didn't have a footprint there. And we saw the same a few years ago with, tornado hail, where some funds were picking up some losses there, but others just weren't playing in that small to medium-sized insurance band of cedents. And so I think that through losses, a silver lining is for managers to differentiate themselves, not only in terms of performance, but also to show the breadth of or the uniqueness of their books of business.
Okay. I mean, thoughts, again, from the panel here about strains in the current operating model or the system. We're hearing, in the press concerns about whether it's trapped capital or what happens come 1/1 renewal, what sort of capacity is going to be back there in the market. Tony, let me start with you and you get your thoughts on that.
Yeah, look, I think this is the beauty of this year is all the business models will be tested. Everyone in this room, everyone in the market, and I think it's an important opportunity to learn. I think that one of the things that I did after Matthew was I gathered the firm and said, look, this was potentially a really scary event, and there was a point in time when you were thinking and you were worried about something. Maybe it was, did I give enough transparency to the investor? Did I document the contract correctly? Did I model it right? Did I ask the right underwriting questions? Did I value it correctly, right? At some point when that storm was heading, you were a little bit concerned. And let's take that and embrace that, right? And let's learn from that. And there were some things that we did after Matthew that I think served us extremely well this past year. So I think that that is an industry, that's the type of stuff we need to be doing. We need to be doing from these events.
Go on.
I mean, I'd agree with that. I mean, over 20 years, we've paid losses. We've, had trapped capital. If you're in the space, that's part of the business, and importantly, know how to deal with it. And right. Not dissimilarly, we have, we don't wait for the event. We have dry runs to figure out, what element of our process is working well and where we got lazy, and making sure that we tighten up the process so when it really does happen, we can perform. And that's really when everybody's tested, is when there's losses, because it doesn't matter what side of the fence you're on, you're here to pay claims, and pay claims quickly.
Dan, are you seeing anything that's stressing the way, either your alternative capital products or even on the traditional side are being affected at the moment?
Yeah, I think from the traditional reinsurer perspective or insurer perspective, the concept of trapped collateral going into a renewal period has been a big focus, and certainly people have been sort of trying to come up with solutions to deliver some liquidity around some of that trapped collateral. But it's I think it focuses the mind of the traditional protection buyer as to the balance between rated paper, collateralized paper, but also diversification of counterparties. So certainly in the retro space, you've seen sort of extreme dominance by a very small number of counterparties, and when these questions come up about the ability of people to roll forward to renew, it's great when they can reload their capital really quickly, right. and deliver that continuity. But it gives people a pause for thought if there's a time period delay and not certainty that capital's reloading. So I think it's something that over 10 years or so you've seen some push towards shrinking reinsurance panels, so having fewer participants on the panel, larger size. But I think that events like this help to encourage that there is value to having multiple participants.
What we might do now is we have a polling question for everyone out there in the audience, and we'll give you the opportunity through your app to access that. And then following that as well, we'll open up for any questions from the audience. We have our question up. I'm just trying to see. Yeah, okay, so the question you have in front of you, which of the following factors do you believe is going to most significantly influence and shape the future of the ILS industry? So we have investors' required return on investment, diversification into new products, changing customer behaviors and buyer habits, technology and innovation, and then the political, regulatory, and tax environment. So I'll just wait for you guys to submit your thoughts there. A little bit of Jeopardy music. What we might do as the results are coming in, I might just go across the panel here and actually just gain perspectives from each of the gentlemen up here. I mean, Tony, would you like to go first? I don't know if you can read the... It looks like investor required return on investment has popped up as 44%, and then it's actually tailing down across diversification, changing customer behaviors, and then it looks pretty close between technology and the political reg tax environment. I don't know if you
so I would, I guess I'd barbell the first and the last place here, because, I mean, again, like I said before, it's matching, capital with risk. So clearly, the way that people are going to buy insurance and reinsurance, how that behavior changes over time, there's going to need to be a response to that. But of course, it's going to match up with investors, and not necessarily the required return on collateral, but a whole laundry list of different things that are going to drive those investor requirements. But I mean, clearly, it's going to have to be an adequate return on that collateral. But it is matching up those two.
Guy, thoughts?
I'd have to agree exactly with Tony, what Tony says, really. I haven't got much to add. Okay. I concur with that.
All right. Dan, your thoughts?
Yeah, I'm leaning more to the technology and innovation, in that I think that when you break that down beyond not just sort of algorithms and tech hardware, but into sort of legal structures and technology in that sense, transaction structures, that for me unlocks all of the other ones. And so it enables you to take risk and return, which isn't necessarily simply attractive to one counterparty. You can do things with how you package that risk to make it attractive. Similar for diversification into new products and unlocking new risk zones. But it's so I think that a lot of roads lead to that technology, whether it is in risk assessment of pricing and trading, or just transaction structuring.
Thank you for those comments. I think we just open it up. If there are any questions from the floor, I have one or two questions here on the app as well. But if there's anyone out there who'd like to pose a question to the panel. Fairly quiet. We did have one that came through here. I'll just pop it out there and I'll let you guys see what you think. I mean, do you think alternative capital can become a meaningful provider of capital to longer tail risk products? So I guess looking at just what risks you're writing at the moment, and the ability or the investor appetite, or even your appetite to move that out into a longer tail risk. Thoughts? I mean, Dan, I'll start with you.
Sure. So I mean, when you look at why is third-party capital coming into this broad arena that we'll call the reinsurance asset class, or ILS, in the property cat space, so short tail, a lot of the major drivers for that decision to come into this asset class is outsized yield versus comparable risk opportunities in other asset classes, and diversification. So you have pockets or teams within large organizations that have a mandate to find risk premium, which is what we call directionally uncorrelated opportunities to the rest of their portfolio, whether it's fixed income or equities or commodities. And so I think that it's when you move into the longer tail types of business, the rationale for capital coming into that is quite different. So when you get into risks which is 5 through 30-year duration, investment income, investment yield, and float becomes much more relevant. And as soon as that becomes relevant, you start to get correlation with people's other traditional asset classes. And so we've seen in the capital markets, phase of yield overlay, where people have taken one asset class and they've overlaid risk premium synthetically onto another. And that's really what we see happening in the longer tail side of the market. But fundamentally, I'd say a large amount of the capital that comes into property cat risk isn't positioned to take longer tail risk naturally for that reason.
Similar thoughts? Or?
Yeah, similar thoughts, and just maybe add a couple of things. Diversification is probably an overused word, and whether that's for ILS in the last 5 years, should we be diversifying to other lines? Or frankly, the traditional model, Bermuda's seen it with reinsurers starting up in property cat because that's been the opportunity post a big event. And then over time, you can't grow that pie because of rating agency restrictions or management's or the street's lack of appetite for volatility. And companies start getting into other lines of business to generate premium, generate revenue, new earning stream. I think we would say, which is why we haven't diversified, is when you get into a new line of business, you need to have experts to get into that line of business. You can be the best property cat underwriter in your own little world, but getting into casualty is a whole different ballgame. And we've seen casualties in the industry that were forced to diversify and got it horribly wrong and got caught out. And that's gone on for years and years and years. I think one of the challenges with long tail is it's a long period of time for discovery. Right. And you don't quite know what's going to be out there for a period of time. And the same thing, it's, can you reserve that adequately? Can you get the returns? It's got to be the investment play as opposed to the pure underwriting return. Right. And it's a tough thing, at least for us, to get our head around.
Yeah, I think a lot of it is, there would just need to be a lot more transparency. So within what investors are currently looking for from the diversification and finding capacity-constrained parts of the market, the property cat is an extremely natural place. And so within that alternative premium section, that's really where the play is. There are many other parts of the balance sheet. There are fixed income parts of the balance sheet, other places where you can have a longer-term investment that is a lower yielding alternative. But in that scenario, you've got tons of transparency, you've got liquidity, you've got all sorts of other elements. So it's not like there's not a place for it. It just as it's currently constructed, where it's like, oh, hey, I was writing U.S. casualty for 5 years. Oh, wait, I'm under-reserved. Like, that world is not a world that is going to work within the context of the market. So I think that, understanding getting more transparency and into that part of the market and getting more well understood is going to be the key to unlocking that. Now, to be fair, I would certainly say that, like, closing the protection gap and talking about flood products and emerging markets and other things are probably the way more tangible lower hanging fruit for investors. So I think that's where at least we're going to focus our energy.
All right, with that, thank you very much for your comments. And if I could just ask you in the audience to show your appreciation for the panelists.